Hey everyone, welcome back to my channel. Today we're diving into one of the most talked about questions in markets right now. What's really driving US stocks and commodities in June 2025? From tariff-driven stock swings to roller coaster commodities prices, this story has it all: uncertainty, opportunity, and big money moves. Over the next 10 minutes, we'll unpack how US equities recovered from a historic crash, whether they can hit new record highs, and what's fueling dramatic shifts in oil, gold, copper, and beyond. Think of it as a financial thriller starring policymakers, geopolitics, and global supply chains. Hit that like button, subscribe if you haven't already, and let's get into it. Section 1. US Stocks. From turbulence to tentative optimism. Rewind to April, the crash. Flashback to April 2nd, 2025. Then President Trump slams a stubborn 10% tariff on nearly all imports. The result? US equities crash. The worst one-day plunge since the COVID upheaval. The Dow plunged 3.2%, S&P lost 3.1%, and marked the beginning of a broader correction that's erased over $3 trillion in market value within days. April felt like a financial apocalypse. It wasn't just US markets. Global equities were gripped by fear. Bonds, traditionally seen as safe havens, initially rallied, but then yields began climbing as fiscal concerns overshadowed sentiment. The healing process. But then, a remarkable rebound. By mid-May, the S&P 500 had clawed back nearly all its April losses. By June, it sat just approximately 1% below its February all-time closing high of 6,144, Wikipedia.org. U.S. large caps delivered their best monthly gain in May in 2 years. S&P plus 6.3%, NASDAQ plus 9.7%, and Dow plus 4.2%. This recovery wasn't driven by blind optimism. It's rooted in strong corporate financials and quieter inflation data. May CPI and PPI both came in lower than expected, reassuring the Fed and markets alike. Where we stand now. Fast forward to mid-June, SPY, the S&P 500 ETF, trades around $597, just off all-time highs. But markets are treading carefully. June 12th saw the S&P drop 1.1%, NASDAQ 1.3%, and Dow 1.8% as geopolitical and trade fears resurfaced. Retail investors are taking note. A Wall Street Journal story today reveals individuals are locking in gains. JP Morgan reports a $17 billion drop in stock buying and net $400 million in selling during May. Analyst perspectives. But it's not all bearish. Citi recently lifted its 2025 year-end S&P target from 5,800 to 6,300, citing strong GDP projections, earnings growth, and tax cuts. MarketWatch.com. Morgan Stanley points out that earnings revision breadth has rebounded sharply, signaling potential 13% annual upside with a target of 6,500, BusinessInsider.com. And their strategist even warns that a mild recession later in 2025, followed by rate cuts, could boost the market to 6,500 to 7,200. Key risks. But let's be real. Risks loom. Inflation surprises or stubborn Powell statements could swiftly undercut sentiment. The Fed retains a cautious stance and may only cut rates once this year. Plus, geopolitical flashpoints, from Middle East flare-ups to surprise tariffs, raise anxiety. Investors remember April's shock tariffs on Canada and Mexico that contributed to this turmoil. Section 2. Commodities. The market's mood ring. Oil, geopolitics at the pump. The oil market has been the biggest barometer of global tension. On June 13th, Israel launched airstrikes on Iran's oil infrastructure. Within minutes, Brent crude shot up 7%, gesturing to highs unseen since the conflict began. By press time, crude hovered at 6-month peaks. Markets are deeply wary of the Strait of Hormuz. If it closes, oil supply could shrink dramatically. Gold, investors' insurance policy. When fear scents the air, gold shines. GLD is trading near $316, and gold's spot price has crept upward $3,400 per ounce. Gold is outperforming crude this year, hinting at deflationary whispers beneath the surface. Increasing political tension and cautious investor sentiment continue driving safe haven demand. Surge in demand looks like it's not calming soon. Analysts now eye 2,000 to 2,100 if volatility sticks around. Copper and base metals, the growth gauge. The copper market presents a fascinating case. U.S. customs-cleared copper is commanding a premium over London markets. Backwardation suggests tight near-term supply. U.S. imports from Chile have nearly doubled year over year. London Metal Exchange inventories are down to 2-year lows. This disconnect points to continued industrial demand, even as global growth remains uneven. Broader commodities and CRB index. The broader CRB commodity index rose approximately 2.4% on June 13th to 379.9 points and is up 4.2% month to month. Agricultural staples like corn and wheat have remained range-bound, while energy, metal, and soft commodity gains reflect a resilient commodity complex. An Aberdeen report argues 2025 may shape into a commodity bull market. Relative to stretched equity valuations, U.S. large caps at 22 times PE, commodities offer an overlooked diversification play. Section 3. The Big Picture Macro Map. Inflation and Fed timing. Inflation is cooling but not yet alarmingly. May CPI PPI prints ran below expectations, providing breathing room for the Fed. Still, rate cuts may be limited, just one this year according to current forecasts. Dollar and currency dynamics. The US dollar index is down slightly from earlier highs, boosting global commodity prices and helping US earnings via overseas exposure. A softer dollar generally favors commodities, especially oil, gold, and industrial metals. Geopolitical stress testing. Geopolitical events have been the single biggest driver for commodity swings and equity volatility. June's Israel-Iran strikes reignited concerns about supply choke points. Historically, asset classes diverge during crises. Safe haven gold rises, oil spikes, stocks stumble. Corporate earnings and tech resilience. But corporate profits remain strong, especially in tech and AI. NVIDIA's rally, Meta and Google growth, and Intel's bounce all support the narrative of earnings-powered optimism. AI-driven capex is projected to top $400 billion in 2025. Trade tensions and tariff threats. Tariffs are never far off. Though April's blanket tariffs triggered chaos, markets have mellowed as talks progress. But the threat stays on the table. Canada-Mexico tariffs are a looming wildcard. Section 4. What to watch next. So, what are the key signals that could shape the next big market move? Let's break it down. Not as bullet points, but as a flowing map of what smart investors are watching right now. First up, trade relations. The US-China dynamic remains tense but strangely quiet, and that silence is making people nervous. Just a few months ago, abrupt tariffs on Canada and Mexico shook equity markets. If the White House reintroduces sweeping trade restrictions, or if talks suddenly collapse, expect stocks to react instantly. Investors are hungry for clarity, but right now they're getting fog. Markets hate fog. Second, Federal Reserve communication is absolutely pivotal. Inflation is showing signs of easing, but the Fed has remained tight-lipped on future cuts. Any unexpected comments from Chair Jerome Powell or sudden shifts in tone during FOMC minutes can create ripple effects across all asset classes. A single mention of persistent inflation can sink equities, while even a hint of policy easing can fuel a full-blown rally. Then there's geopolitical stress, and it's not just background noise anymore. The Middle East remains a hot spot, and tensions between Israel and Iran recently sent crude oil up 7% in a day. If conflict escalates or threatens major energy infrastructure like the Strait of Hormuz, commodity prices could skyrocket, sparking renewed volatility in both bonds and equities. Another powerful signal? The commodities-equities spread. Historically, when commodities like oil and gold outperform stocks, it often signals market stress or rotation into defensive assets. On the flip side, when stocks outperform during rising commodity prices, it's usually a bullish sign of growth confidence. Keep an eye on these trends. They often whisper what the markets will scream later. And finally, earnings season and tech momentum. With tech giants like NVIDIA, Google, and Apple acting as market anchors, their earnings not only shape stock performance but also influence broader sentiment. As AI continues to lead innovation, any signs of slowing revenue or capex pullback in this sector could pull down the broader indices. The key takeaway? Watch the signals, read the tone behind headlines, and never underestimate the power of timing in this rapidly evolving market. Section 5. Strategy Recommendations. So, how do you play this market without getting whipsawed by every headline? Here are 5 expanded strategies to help you navigate the current landscape smartly, calmly, and profitably. 1. Stay diversified, stay grounded. Diversification isn't just a safety net, it's a strategy. While the S&P 500 and NASDAQ have dominated headlines, spreading your capital across US large caps Emerging markets, select commodities, and fixed income can reduce volatility and increase resilience. Allocate 60 to 70% to equities, 15 to 20% to commodities like gold or oil, and the rest in short to medium duration bonds. And yes, cash can be a position too, especially during pullbacks. 2. Use safe havens as tactical tools. Gold, treasury bonds, and the dollar aren't just defensive, they're reactive tools. When tensions rise, lean into them. For instance, gold nearing or breaking $2,000 per ounce could be your cue to raise allocations. Similarly, a VIX spike above 25 might justify shifting 10% to long-duration treasuries or a volatility ETF like VXX. Think of these as your market airbags. 3. Be macro-aware, but not macro-obsessed. Don't get caught reacting emotionally to every inflation number or Powell speech. Instead, set alerts and predefine your response. For example, if CPI prints above 3.5%, rotate partially into defensives like utilities or healthcare. If Fed signals 2 rate cuts, rotate back into growth and tech. Build the system before the storm. 4. Invest in narrative-backed growth. The AI boom isn't just hype, it's structural. Look for companies that are not only riding the trend but building its infrastructure. NVIDIA, AMD, Google Cloud, Palantir, and data center REITs like Equinix. This isn't about FOMO, it's about placing smart bets on long-term innovation. Be selective. Buy dips, not highs. 5. Watch commodities as market compass. When copper prices rise, that's industrial demand talking. When oil spikes, that's geopolitical fear. When gold climbs, it's a sentiment signal. Each commodity tells a story. Sync your equity positions with those signals. If oil rises but tech holds firm, that's a bullish green light. If oil rises and tech drops, it's a warning flare. Bottom line, this isn't a time for panic or paralysis. It's a time for proactive planning. Smart investors don't guess, they prepare. Let's wrap it up. U.S. markets have staged a dramatic recovery since April's tariff-triggered crash, settling back near record territory. Commodities are flashing warning signs and opportunity. Oil surging on conflict, gold climbing on uncertainty, copper tightening on supply constraints. The macro picture is nuanced. Inflation isn't exploding, but the Fed still isn't pivoting yet. Politics and geopolitics can roil markets. Earnings and tech momentum remain supportive. For investors, it's about maintaining balance, mixing growth with protection, agility with discipline. The next few months could bring volatility, but also opportunity for those prepared. If you found this breakdown helpful, give the video a thumbs up, subscribe, and ring that bell. Drop your views in the comments. Are you going full risk on or playing defense? Next week, we'll dive into bond strategies for mid-2025 and why yield curves may make you rethink a cash-first approach. Until next time, stay sharp and capital smart.